Uh, Good afternoon, everyone. My name is Ramendra Bhatia, and on behalf of ASK Investment Managers, I welcome you all to ASK EOP Quarterly Update Call. Today, we have with us Mr. Chetan Thacker. Chetan Thacker is Portfolio Manager, has a total work experience of more than 16 years with 10 years plus in equity research. He has a sector research expertise in agriculture, chemicals, metals, mining, and mid caps. Previously, Mr. Chetan Thacker has worked with McKinsey Company, HSBC Invest Direct, MK Global Financial Services. His education qualification includes CFA and PGDBM from NMIMS. He is with ASK since 2015. Today, we have scheduled this webinar wherein I would request Chetan to cover the broader trends in the market for 10-15 minutes, followed by a deeper understanding of the ASK Emerging Opportunities portfolio, giving an insight on what happened till now in FY24. Where do we stand now and how we see things going forward? This would be followed by Q&A. I would request all of you to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. So Chetan, thank you so much for joining in, and all over to you. Thanks.
Thank you so much, Raminder. Thank you everyone for joining us on this quarterly update call for the Emerging Opportunities portfolio. So as Raminder highlighted, we'll just briefly cover on the portfolio, the outlook for the market, what we witnessed, our expectations, and the changes that we made to the portfolio, and how do we see things shaping up going ahead. So just to begin, starting with the macros in particular. So what we witnessed in Q2 is similar lines to what our expectation was when we started this particular year. We've essentially witnessed CapEx intensity sustaining in Q2. This was the trend which was similar in Q1. It's still quite evident by the consumption of steel, cement, and anything which is allied to the capital goods side, be it cables or be it other capital good names. So we are essentially seeing CapEx continuing to lead growth in the first half of FY24. This is largely driven by the fact that we are seeing fast execution of a lot of projects, not only at the central level, but also at the state level, as we approach the general elections next year. On the consumption side, I think what we witnessed and as anticipated, Q2 has continued to remain muted. There is obviously a factor which is playing out here, which is the base. We had essentially festive season, which was a month earlier last year. So that in a way has been impacting the base, because of which the consumption demand continues to look muted in Q2 FY24. While managements have been guiding for an uptick towards the end of the quarter, which is where the festive typically kicks in. Coming to festive in a greater detail, the feedback that we've received from a lot of our channel checks, they typically suggest that we are essentially seeing an uptick in consumer durables. There has been a festive uptick which has been witnessed in two-wheelers, passenger vehicles. Within the auto pack, what has remained muted is the tractors. Apart from tractors, I think all the other segments have witnessed decent uptick as far as the festive is concerned. The uptick is more so on the urban side, while there is still fair degree of muted response on the rural side. That can be on the back of the fact that we had witnessed very disturbed monsoon this year. The spatial distribution wasn't great. That has essentially meant that food price inflation has continued to notch higher, keeping the CPI under pressure. The backdrop on the global side is we've essentially seen a lot of news flows flowing on from the global side, but what is clearly more relevant for us is the fact that exports have been dragging as far as the first half is concerned. Export growth at an overall level has been down 9% YOY, H1 to H1. There are a couple of reasons that we've been highlighting. One clearly is the fact that while on the backdrop, there is slowdown in global growth itself, which has been impacting exports. However, there is also an adjustment that is happening, particularly on the stocking side. We had essentially witnessed the inventory days of the entire supply chain extend in the time of COVID, as people were worried about supply bottlenecks, which in turn would have impacted their own supply chains. So people had essentially expanded the supply chain period. What we are witnessing now is that is getting normalized and moving to more towards the pre-COVID level in terms of the number of days of supply chains that were present across a lot of industries. Coupled with that, we've also seen a fair degree of dumping, which has happened from China across a lot of industries, which has not only impacted volumes for us, but that has also impacted spreads. So exports has been a drag as far as the first half is concerned. Our outlook on the exports is, and what we are hearing from most of the managements is, while Q3 will still continue to remain muted, We essentially believe that Q3 is where their festive season largely plays out. So a lot of inventory should clear from the channel, which in turn means that Q4 is where you start to see some degree of normalization as far as exports are concerned. On the positive side, what has clearly played out is lower input costs, which have been driving margin expansion. This is something that we've been highlighting, that the story of this particular year will be broken up largely into two halves. The first half will be a story of margin expansion, sustaining earnings growth, and we are seeing that evidently play out. The second half will be a function of both volume growth, first to begin with on the domestic side with festive, and followed by what happens on the export front as we move into Q4. So far, the commentary points towards a positive outlook as far as the festive is concerned. There are obviously certain pockets where it has still remained muted, but there are pockets which have witnessed good demand in the festival season. So that should help a recovery in the volumes as far as Q3 on the domestic side is concerned. The ensuing Rabi season is what will be watched very closely. We've had an adverse monsoon season in Kharif, which means there is a risk of higher food inflation kicking in, which can impact CPI. If the Rabi season does not get impacted, then I think that impact will be muted. But if we actually see that playing out even on the Rabi season, we might see food inflation continuing to remain sticky. On top of all this, I think two things which we'll have to monitor from a more global macro point of view is the evolving geopolitical situation that has a ramification as far as the crude bit or the imported bit of inflation is concerned for us. Second bit is obviously to some degree it starts to impact global demand as well. So what we witnessed in this first half is, if we were to split what the commentary is from most of the managements, it's quite evident that Europe has been struggling more compared to US, which in turn has been putting pressure as far as exports are concerned. As we move ahead, I think we'll kick into the election calendar. We are already seeing 5 state elections underway at this point of time. That will get, we'll move on and move into the general election as we head into the next fiscal year. Coming to the portfolios in particular, what we've been doing in the last few months, particularly this fiscal year, is that we have been gradually moving positions on the sector allocation to pockets and spaces which we believe are firmly going to benefit from the structural tailwind that we are witnessing, both in terms of acceleration of domestic growth, coupled with the fact that manufacturing in India is taking off and we are seeing early signs of that. That essentially means that certain segments of the market will continue to do well from a more medium to long-term perspective. And we've kept the same perspective while we made changes to the portfolio. A result of that is we've actually seen weight increase on the infra and engineering side with a number of weight addition on the capital goods space. We've added names on the pharma side as well. We've added an additional exposure on utilities by way of ports and logistics. Logistics was another name that we've added to the portfolio. Automotive is another pocket where our weightages were lower. We've essentially gone ahead and added weight on the auto ancillary side as well. And you will see that playing out. A primary reason for playing the auto bit through ancillary is two-pronged. One clearly is what we are witnessing as far as the domestic recovery and domestic growth itself is concerned. There is a penetration-led opportunity which is clearly available in the PV side. There is a premiumization opportunity which will play out on the two-wheeler side, while penetration and premiumization both play out on the passenger vehicle side. Apart from this, what is more interesting on the auto / engineering space is that we are essentially now seeing a lot of traction coming from the export market. What we are essentially witnessing is that there is a structural shift of supply chain which is happening from US and Europe. The cost of production there and cost curves there have shot up. In Europe, the issue largely is energy cost. In US, the issue is largely labor cost. So we are essentially seeing a lot of large MNCs now looking to outsource more away from their region and shifting manufacturing bases to other places in the world. Our assessment is that from a government policy push point of view, PLIs play a crucial role as far as providing that platform to most of the Indian entities to compete. Coupled with which we have a tweak on the tax side, we have GST, which makes mobilization more easy. The entire logistics push, which will help bring down logistics cost from 12% as we move towards a benchmark of 8%, which should improve competitiveness as far as Indian exports are concerned. So our assessment is there will be pockets which are available and which will be available on capital, on the auto ancillaries side, on the engineering side, which will benefit from the structural tailwind as well. So you essentially gradually increased allocation in those pockets. If we were to look at the breakup of the portfolio, the way it stands is we have 28% on large caps. Some of the large caps are essentially mid caps, which have now graduated into large caps. So we are seeing that transition happen within the portfolio. We've actually seen names such as Polycap, which have transitioned from a mid cap to a large cap exposure in this period itself. While predominantly the portfolio continues to remain mid cap and small cap focused. As far as performance is concerned, we started to see some degree of gradual catch up, and our expectation is as earnings delivery continues to remain robust for the portfolio, we should remain on this trajectory of catch up. Coming to the changes that we've done in this period, in this entire period, as I was highlighting, we've added essentially weights primarily on the pharma side, on the auto ancillary side, capital goods, utilities, and chemicals. So those are the pockets which we continue to believe will benefit from a more medium to long-term perspective, and that is where we made these changes. You will still see some degree of changes that continue to happen in this portfolio as we move ahead and we continue to rebalance this portfolio. Coming to the Q2 FY24 earnings in particular, as highlighted, margin expansion was a key driver as far as earnings growth are concerned. Exports continued to remain muted. What we witnessed in Q2 is capex-led volume growth, which sustained from Q1, and that momentum carried on. On the financial side, we've actually seen numbers getting delivered, which were in line with expectations. A pocket of weakness has clearly been chemical and pharma intermediates, which witnessed pressure. This is on the backdrop of what I just highlighted, which is lower export volumes and compressions in spreads. Our assessment is that as we move ahead into the second half of FY24, more so on Q4, you will start to see exports starting to contribute from being a drag in this particular financial year so far. As we move ahead into FY25, our assessment is that structural tailwinds will gather pace and momentum, which should lead to not only volume growth, but we'll also see some degree of normalization in spreads as the entire pressure of destocking starts to wave off. IT as a pocket continued to witness muted earnings growth, which was in line with expectation, while domestic pharma and the US pharma reported results which were better than expected on the back of stable volume on the domestic side, margin expansion which played out primarily because of lower input cost, and what you've essentially seen fair degree of lower erosion as far as pricing in US is concerned, which has meant that pharma as a pack has done well as far as earnings delivery is concerned. Auto sector, on the other hand, witnessed margin expansion as lower input cost fueled through, and as far as the OPEX is concerned. Plus, what we witnessed is operating leverage play out on the positive side as volumes pick up. Our assessment is in Q3, you will see this operating leverage play out much more stronger because you will have a higher volume base as you get the festive volumes in place in the third quarter, primarily because of the shift that we witnessed in the festive season. On the consumer discretionary side, volumes continue to remain muted because of shift in festive. A commentary is pointing towards a more buoyant festive season, which essentially means volume should start to look up in the second half, more so in the third quarter as we move ahead. Coming to the earnings performance of the portfolio as a whole, as highlighted, we've essentially seen 31% operating profit growth, 45% PAT growth at a portfolio level, which compares with the 19% PAT growth as far as the benchmark is concerned, and 14% operating profit growth as far as the benchmark is concerned. For the outlook, as we move ahead for the full fiscal FY24 and FY25, we essentially expect acceleration to continue in operating profits, more so on the PAT side, and we believe that the gap as far as earnings between the EOP portfolio and the benchmark will continue to sustain. As far as the psychography are concerned, as highlighted, the expectation is ROCs will continue to remain elevated. What is interesting and what we would like to point out is this particular slide here, and this is something that we've been highlighting for some time. Over the course of the last 2.5 to 3 years, what has essentially happened is while we've seen our portfolios continue to deliver on the earnings front, what has played out is because of cumulative factors, primarily higher cost of capital globally, which shot up significantly in the last 12 to 13 months. What we've witnessed is there has been some degree of compression as far as the valuation of the portfolio is concerned. So this slide clearly highlights, so this essentially points towards 1 year and 2 year forward PE for the portfolio as a whole. In March 21, this portfolio had a 2-year forward PE of 42. What we witness now is because of earnings delivery continuing to sustain in line with what we are expecting. While the portfolio has not moved in line with the earnings delivery, we've actually seen valuations contract here, and they today stand at 25.5. So we've actually seen valuation contraction here. The way we are looking at this from a more medium term point of view is that as we accelerate earnings growth for the portfolio, the earnings growth should start to reflect on the performance of the portfolio itself. Typically, there is a lead lag that plays out more so in period of volatility and particularly in periods where cost of capital has gone up. So our expectation is that we have to be compensated largely because of the earnings delivery that the portfolio has delivered, plus the fact that at some stage we will get a tailwind as far as the cost of capital itself is concerned. Our assessment is we are probably closer to the peak as far as the global cost of capital is concerned. The question is, till how long do we sustain here? Our assessment in the initial period was that we will probably remain here for a tad bit longer period of time, and we are monitoring this closely. As we move ahead, you will get this tailwind play out as interest rates start to inch down. We've essentially seen incremental data which has come on inflation, which is pointing towards some degree of cooling off of inflation at a global level. While most of the central banks have gone in for a pause, similar to what the RBI has done, to let the increased interest rate ramifications play out, because typically they also play out with a lag. So our assessment is that at some stage you will get this tailwind that will play out coupled with earnings growth that will play out for the portfolio. So as we look ahead, our assessment is earnings growth momentum will continue to accelerate. As we move into FY25, margins will be a lesser play than what we witnessed in first half of FY24. It will largely come from volume, and volume will be driven by both domestic as far as consumption growth at a local level is concerned, while exports, which have been a drag, will start to contribute. And given the structural tailwinds, if we see a faster recovery as far as global growth is concerned, you can actually see a faster delivery on the export front as well, and acceleration that we are expecting on the exports front. So this is how we see things going ahead. I will just pause here and we'll be happy to take any questions.
Participant, I would request all of you to type in your question and queries related to the portfolio, and we shall curate and try to get them answered. Chetan, a lot of participants wish to know that this is a mid-cap biased fund. Firstly, is it an apple-to-apple comparison with a pure mid-cap or small-cap fund? Secondly, we have seen the fund underperform in the broader small mid-cap segment. Any thoughts on the same?
Yeah, so if you look at our performance, while clearly there has been an underperformance, and we were essentially, when we were looking at the underperformance and from where in particular this underperformance is coming from, a large contributor to the underperformance has been the financial pack itself. Now, if you look at the mid-cap index and the constituents of that mid-cap index, what we witnessed on the financial side is that there is a large degree of weightage on the index side, which is more towards businesses which are subpar as far as the ROE potentials itself is concerned. What has played out in the last 1.5 years in particular is primarily driven by the accelerated increase in cost of capital and the RBI rate increases. We've essentially seen a faster normalization in ROEs as far as the names in the index are concerned. So just to share some numbers, what has happened over the course of the last 2 years or 3 years is, in FY21, you had the cumulative loss of all the entities, particularly on the bank side, which are a part of this constituent, reporting a loss of closer to 28,000. Largely because of the rate increases, which the RBI has done, which essentially meant that spreads expanded because cost of deposits only started to move up since November of last year. And we've still not seen that completely get factored in as far as earnings are concerned. Our sense is that will happen as we move ahead in Q3 and Q4. Coupled with that, you had an extraordinarily lower provisioning because most of these entities had not grown in the past. So credit cost is also lower than what the normal credit cost should be. A combination of both these factors has essentially meant that this cumulative net loss has essentially swung to a net profit of 25,000-26,000 crore. When we look at things from here on, the equation will clearly shift back to who can deliver growth while keeping sound underwriting practices in place. As we look at that, and as we look at the portfolio earnings in the same period, the constituents which were a part of our portfolio delivered an 18% CAGR as far as profits are concerned. From an ROE perspective, if the cumulative ROE of the constituents would be closer to 12 to 13%, the ROEs for the entities which are a part of our portfolio is closer to 20%. So clearly, ROE itself is a cap as far as growth that these entities can deliver. So our sense is, as we look ahead, these are cycles which typically play out. What you've essentially seen a faster normalization as far as those businesses are concerned. But as we look ahead, again, growth will be in focus. Growth in turn gets determined by the underwriting capability of the entities and the ROE profile of these entities, which in turn is driven by the kind of business you want to do, which is on the asset side, and the kind of liabilities that you can attract. So our sense is earnings growth will continue to remain higher for our portfolio constituents, which in turn has not got reflected as far as returns are concerned. So at some stage, we will start getting compensation for the earnings growth that has got delivered, plus to some degree the devaluation that we have witnessed, and that has been quite significant when you look at the portfolio as a whole, which I highlighted in the slide. We've actually seen a fair degree of devaluation that has played out in this period. So our assessment is that this was one big drag as far as the underperformance with the index itself is concerned. Apart from that, there were certain pockets where we had lower allocation. So most of the changes that we've done in this period of time is keeping in line with what we expect structurally to happen. Businesses where we want to participate within that space itself, and which fit in line with our philosophy of long-term preservation and growth. So we are looking at names which will qualify for our investment philosophy, which is preservation and growth, which is a combination that we look at for most of the new additions also that we've done. For all of them, this is a core factor that we are seeing, and that is how we essentially build weights in the portfolio. So one pocket where we believe there was a need to readjust the portfolio is what we've done in this period, and it is an ongoing exercise. We'll continue to do that. A pocket which has been a drag had been a drag because of normalization which happened at a faster rate for those entities, while our part of the pocket, despite delivering earnings growth, witnessed some degree of derating in that same period. So our sense is, when we look at the mid-cap index as a whole, what we believe is entities or names which will continue to deliver in line with essentially the higher expected growth that is built into those valuations will still continue to either sustain, or if they beat those expectations, do well. But names which will disappoint in this entire pack compared to what has been built into those numbers, you will start to see disappointment in those particular pockets. So as we move ahead, within that pocket itself, things will become more stock specific in terms of names which can deliver, will continue to deliver on returns, while the other part, which does not deliver in line with what the expectations have got built in, will to some degree start to falter as far as return potential is concerned.
Okay, thanks. Next question is that at current point of time, everyone talks mid-cap valuations are an elevated level. You have added a lot of new stocks in the portfolio. What's your view on the mid-caps now?
So we've remained consistent with what we believe. We essentially believe in picking names where we see long-term growth opportunity, where we see an ability to compound earnings, the size of opportunity is meaningful for us to participate, and we get them at a reasonable return potential. So that is what we continue to evaluate as we made these changes. These changes are made keeping in line with the structural changes that we believe will happen as we move ahead. Just adding on to that, so just a couple of snippets there. So the way we are looking at things as we move ahead is, if you were to bifurcate between sectors, there is one clear leg of exports, which is in turn linked with manufacturing in general. Manufacturing has a clear tailwind. There was a tailwind, particularly on China plus one. Our assessment was that that will play out, but it will play out at a more gradual rate. What we've started to witness, particularly in the last year, because of what has happened to energy costs, what has happened to labor costs in the US, is that we are now actually seeing a far more accelerated opportunity that is opening up from US and Europe, as those businesses look at pockets or regions where they can outsource and bring down cost to compete. That is one structural tailwind that will play out. And that is what we are trying to capture as far as the portfolio itself is concerned. Coming to the domestic side, our assessment is that as a country, our aspirations have significantly gone up in the last decade or so. What that essentially means, as far as consumption itself is concerned, is that within consumption, you will see a faster growth on the consumer discretionary side. Even within staples, companies which have a portfolio which is more on the premium side will still continue to deliver faster earnings growth as compared to the entire pack, because penetration in a lot of these segments and sectors would be fairly decent, barring the discretionary bit, which will continue to accelerate as the country gets richer and as the country progresses on those lines. So on the domestic side, our assessment is capex will be a big driver. You will have a driver which is in terms of consumer discretionary slash premiumization, which will play out. The third bit of delivery will happen more on the manufacturing, which will be a combination of both substitute of imports plus a fair degree of opportunity that opens up on the exports front across a lot of industries. So our sense is, if we were to stretch the timeline, these will be the three mega drivers as far as the earnings potential is concerned. And we've kept that in mind as we have made these changes in the book.
Okay. Next is EOP being a mid-cap fund. We are hearing a lot about bit of froth getting set in the space. Do we see that in our set of mid-cap names?
No, so clearly there is a stark difference if you look at this fiscal year in particular, and if you compare the returns between the mid-cap index and the large-cap index, there is a clear differentiation that happens. That has happened and that has played out. One reason for that is when you essentially evaluate and you look at the spectrum of things and look at more data into the past, whenever there is an expectation of growth accelerating and becoming more broad-based, you typically have periods where a lot more entities can participate in that growth, which in turn means that a fair degree of number of entities will start to participate in that growth. And to that extent, that gets built into the expectation from that particular pocket. What we witnessed is we witnessed the entire pack do well in this particular period. And as I was highlighting, as we look ahead, given where valuations are for mid caps and where valuations are for large caps, I think it will boil down to the bare basics of delivery of return, which is entities which can deliver on expectations which have got built in and exceed that expectations will continue to do well. Entities will start to falter on those expectations. You will start to see underperformance coming in those entities. I think at the bottom line, it essentially boils down to capital efficiency and cash flow that gets generated, the size of opportunity, compounding capability, and capability of the management to capture the available opportunity size. So we continue to remain focused as far as those tenets of investments are concerned. And our sense is, be it large cap or mid cap, any entity which continues to deliver on this, you will still continue to see delivery. But a pack performance will now basically move more into a stock performance as we look at it.
Okay. Next question is, we see multiple changes being done in the portfolio in this financial year. What led to these changes? Interesting names are being added like Kenna Metals, Sansera Engineering, JSW Infra. Would like to understand your rationale for owning them, and with active management with respect to stock changes, how do we see the fund going forward?
So, like I was highlighting, I think what we are trying to do is, as we reject these portfolios, and what we've always done is we've always kept the more medium to long term in focus. From a more medium to long term perspective, those were the three mega trends that we believe will play out as we look ahead, which is consumer discretionary doing better within the consumption pack, exports as an opportunity being fairly large, which will play out on the manufacturing and the engineering side, and import substitute. So our assessment is whatever will be an enabler for these three trends, you will essentially see those also doing well. So the logistics bit fits into that because you need competitiveness as far as logistics are concerned. Today, the logistics cost at a country level is 12% of GDP. There is a clear focus from the government to bring it down to 8% of GDP to improve competitiveness. Most of the names which you just highlighted and which we've added are a beneficiary of that trend. These are businesses and names which have built prudent businesses on those particular pockets where we want to participate. And so it's essentially all linked to the three things that we believe will play out more structurally. And whatever will benefit out of these three things playing out is where we've essentially increased allocation in the.
Okay, though you have covered in the last couple of slides, how does the portfolio look with respect to the return ratio of EPS growth, ROEs, ROCs for FY24 and 25?
So yes, as shared on the slide itself, what we essentially believe for the next 2 years is we essentially expect ROC in FY24 to be closer to 27% for the portfolio as a whole. That accelerates to closer to 32% in FY25. That acceleration is largely happening because of the acceleration of profits as we sweat those assets better within the portfolio companies. From an EPS growth perspective, this year we expect a 28% kind of EPS growth for the portfolio at a PAT level, while for FY25 that number moves to 35%. Interestingly, what has happened as we've continued to deliver on earnings is that returns have not been commensurate with that, which has meant that valuations have become a fair bit more attractive. So the way to look at it is the benchmark in the same period. While we've done better than the benchmark in terms of earnings growth, what has happened is valuations there have moved a notch higher. While despite doing better on earnings growth, we've actually seen valuations in our pocket come down. One key factor for that is cost of capital, because we are on high quality, high growth. Typically, that is a pocket which gets impacted whenever you see such sharp increases in cost of capital. So our sense is if our portfolio companies continue to deliver on the earnings growth, you will essentially see returns get compensated for that. Plus, whenever you get the tailwind, that will play out as far as cost of capital is concerned, that should help catch up on the underperformances.
Okay, next question is someone is asking that what is the update on the leadership change at ASK and any impact on the how we manage the stocks? This is the question. Yeah.
So it continues to remain the same. The same team continues to remain in place. Our endeavor is first to obviously tackle the issue of underperformance, make changes which are more structural in nature, where we believe that catch-up can happen. So there is no change in particular as far as the leadership is concerned. What has changed internally in the last few months is we focused a lot more on what is there in the benchmark. If we are not participating in a particular name actively, we have a fair degree of reason for not participating in that name. While we continue to remain steadfast to the opportunities that are more structural in nature and make changes which are necessary to be made to the portfolio to strengthen the portfolio, pockets where we were underweight, see if there is an opportunity to increase weight while keeping the investment philosophy intact.
Any other question, participants? You can please type in your question in the chat box. I think there are no more questions from the participants. Chetan, thank you so much for taking out time and discussion on the EOP quarterly update call. Thank you so much.
Thank you
Participants,
everyone
yeah.
for participating in this particular update. If there are any questions which you feel still need to be answered, please feel free to bounce it off us. We'll be more than happy to answer to those questions. Thank you.
Thank you so much all. Thank you.